All right. Let's see. Give me a thumbs up if you guys hear me, and we'll get going. Sweet. All right, guys. Welcome to the Hurley Investments Trade Findings and Adjustments of February 23rd, 2023. Lots of twos and threes. All right. What are we looking at today? So we're just going to go over a couple charts. We're going to talk a little bit about what we went over last time very briefly, and we're going to then talk about price versus value. So let's get going. All right. Let's see. What did we talk about last time? Lots of Meta, Baidu, Apple. Talked about earnings. Basically, we've gotten puts on everything as our market started to fall back below that 4,100 level. I think we went over this stuff enough. We can erase this. Talked about how our market's doing. Why are we moving down more? Has more to do with another inflation reading, the what is it? Not PPE. What's the acronym? Maybe one of you can help me. But anyways, coming in hotter than expected once again. And Fed minutes showing they really aren't interested in. No, it wasn't. There it is, the PCE. That's what it was. We had the PPI, CPI, and then this week had the PCE prices. Those came in hotter than expected. The Fed minutes suggested they're obviously, and once again, and I don't know why the market keeps falling for anything outside of it, but they are obviously only focused on getting inflation down. The one, I guess, positive for the market would still be that the Fed will still continue slowing down their increases, meaning, quarter point rate increases, or halting it at some point later this year and just sitting pat with where are we at, like 4.25 points. We came up 5% or whatever. That's really the only positive, and I think we've kind of run through that positive. I think that's pretty much what all of this was. If you can look at the chart, this big run in from October came back towards the end of the year, and then the run in after the beginning of the year, all on the idea that the Fed is really might sit pat at this level of interest rates and see how things flesh out over the next few months and quarters. And Disney, geez, once again, like Under Armour, let's take a look again just real quick. Disney, this was their earnings day, or at least the day after. Opened way up there at 118 and just crapped out. all the way back down to the 50-day. Couldn't even get their 50-day to cross over their 200 like a lot of stocks have. And they did great. Just like Under Armour, they did great and just kind of crapped out. And the only reason we can think of as to why is just profit taking on a nice run up over the last quarter, several months, and some follow through with those inflation numbers that have not been positive for the market. So, pretty much everything, if you go through, is either kind of looks like this coming down, but a lot of stuff coming down to moving averages. So 200 here for Apple, 50 here for the S&P, and a pivot point. I think we had a little bit of a bounce off of um, these support levels this morning. Everything opened higher, as you can see pretty close here. It almost to the penny. The S&P hit that 50-day and looked like it was bouncing up above this morning. Um, so what I would expect is hitting these support levels over the next couple days and trying to hold them, and in the process kind of using up all those buy orders that are stacked up on those support levels, those moving averages, and probably heading back down to 3,800 if we can't seem to hold those. Not a lot of stuff in the next quarter really think to really catalyst the market up. Nothing that I can think of, unless you guys can think of anything. We've got tax selling that'll be coming here in close to April and before April. We've got really nothing unless we get some crazy inflation report next month or next couple months that is another slowdown in the rate of inflation, which has even happened uh, since they started raising interest rates. I mean, last 21 summer of 20, well, last summer 22. So everything came up significantly. Let's look at Apple. That might be a better one. Yeah, so June, July, August. This was a huge run up for most everything, especially tech stocks, when we had a lower inflation reading, and then everything reversed as inflation didn't decided to continue up. So, well, we could get a reaction like that and an inflation change like that, but really doesn't seem to be a lot of positive things coming forward. We might have, a little bit better earnings the next go around. This one was kind of crap and left a lot to be desired by a lot of stocks. Um, except most of our stocks looked really great. So kind of frustrating, obviously, to see things come back and peter out and really not continue to take off. But again, a lot of stuff has taken off over the last several months. So I think the market's kind of doing the same thing we're doing and looking ahead and realizing there's what else is there ahead to justify buying, continue to buy more and push things up. So the question is, why do some stocks that had great earnings not continue up? And the thought is, to reiterate, those stocks already had a good run over the last quarter. Looking ahead, it's hard to justify buying into future catalysts that aren't there for the market. Profit taking on a good quarter. I'll say good bullish, short-term bullish quarter. Questions or thoughts on those? So maybe the next question is, what is the next catalyst? There's not one shortly in the next quarter that I could think of. What would be the next catalyst? What do you guys think? What could be the next thing that drives our market ahead? So here's one. Oh, I got an answer here. Debt limit issues. Jim says debt limit issues. I don't think that's a catalyst, Jim, unless I'm misunderstanding what you're saying. That kind of seems more like a I guess a negative. Would be nice if we could get some legislation in that required um, that the Republicans are trying to do to get more responsible spending and an attempt to pay down at least not increase the debt limit so much. It's getting out of control for sure. Another response, which was what I was going to go with, is rate hike stopping from the Fed. So yeah, the next interest rate being 0. So if they flatline, they went 75, then to 50 back in December. Now this last month went to 25 basis points or quarter percent. It would be quite positive for the market if we went to 0 next time. I can kind of see him going to trying to do another quarter percent hike again, but they've also kind of indicated they like where they're at and are willing to kind of wait a little bit and see where things go from here. But that definitely could be the next thing. All right. So what happens if stocks keep falling down and we get to 3,800, it keeps going down, it goes down to 3,600. What are we gonna do? What do you guys think? I know what I'm gonna do. I'm gonna say enjoy another opportunity to buy more shares again. Yes, I'll admit it was nice to have that run up for a while, and certainly, I mean, I don't want to get too far ahead of myself. We're really only coming back to a 50-day moving average right now, and the market could go sideways. It could kind of bounce and continue to go up. There's all sorts of stupid things that make no sense that the market will do. But we're talking about if it continues down, right? So we'll enjoy another opportunity. Buy more shares when it gets down. We've got Apple. We weren't really ever able to add more shares for Apple, although we did make up a good portion of the downward movement and just didn't translate into new shares, unfortunately. If we get another dip down to 127, 126, would be nice to see if we might have enough to get some more shares there. Baidu had an amazing run up. Kind of ridiculous. Baidu earnings were fantastic. 5 billion in share buybacks they announced, and opened up at 150 yesterday and just plummeted back down to 137 today, kind of trying to hold on. It was bouncing a little bit, back down again, 137. Kind of frustrating. But again, I don't think it will go back down to 80. But even if it goes down to what, 120, I would say if it doesn't hold any of these moving averages, 120 is our next spot. And maybe 110. than 100. There's several spots here we could be making quite a bit. I mean, this chart looks like it's, I don't know, it doesn't move as much as it does until you really look at these numbers. I mean, just yesterday it was up at 150 and it's moved down, almost $15. Kind of crazy. That's a lot. So any of those fall points that it falls down to is pretty significant. Disney all the way back down to 100. I mean, if we got back down, we wouldn't even have to necessarily get back down to 87 or 85. 92, I'm kind of seeing some spots here, maybe 97. But all of this has been protected. We've had protection through earnings, so we're making a good amount there on Disney. Boeing's just kind of gone sideways, but we have, I think, 110s there. Let's see, Meta we had at, I think, 185. It's down at 170, so those are looking good. So we've got enough protection on. You definitely can make you definitely can have some positivity about adding some shares. Go back to Baidu one more time. We had Baidu up at 160 and thought, you know what? Right here before earnings, let's roll those down to 140 because we want to book a profit on the 160s that came down $20 and have a little bit less expensive 140s that if it went up big, we could take those off a little easier and not lose as much on our premium for the puts. Didn't quite go that way, but we also aren't really down significantly from there either. All right. So this brings me to the next point, which is price versus value. So a lot of the time we kind of conflate these two things, and you kind of uh, someone new to the stock market, they might think of these things as the same, but they're quite different. We know there's a difference between where a stock might trade in price and what their value is. I think for a couple companies, we've talked about price to book ratio, and the book is basically all of companies' assets that can be sold right now and how much those hard assets are worth. And I believe at the lows from, and it might be still true, I'd have to check, but the lows for Meta and Baidu, they were trading at a stock price lower than the actual assets they had, the actual book value, which is stupid, but it's also kind of cool because it also means that we have an opportunity there, similar to what I've been on about And so I think it's important to kind of, again, take a step back and really pay attention to value a lot more than price. So some differences here. Let's see. I had a good one. While I'm thinking of some things, what do you guys think? What are some differences between price and value? Okay, so here was my first one. So that first one, stocks run on price. I'll actually change that to emotion. And this is a Warren Buffett thing. And of course, a lot of what we're going to talk about here is the Warren Buffett value investing principles. Perfect. I like it, Jim. Price is more short term than value. And that's very similar to what I'm saying. What else? Changes in stock price on a shorter term basis, kind of what you were saying, Jim. They aren't always logical or based on fundamentals. And of course, value is all about fundamentals. And in fact, if we're going to try to define value to the best of our ability, it would be something like the value we place on fundamentals, earnings, profit, um, how a company delivers value to its shareholders, how a company generates growth and wealth to its shareholders. Any other better ways I could describe that? So if you can take that step back, focus on the value, and a lot of the time I'm looking at charts in here on our webinars talking about what you know prices are doing a lot of the time. Maybe I ought to change that a little bit, focus a little more on the value, but the charts are what change a lot more. Value, we get an idea of fundamentals every quarter, right, in an earnings report. And we talk a little bit about earnings and the reaction and what we're going to do about all that. But really, all we're talking about is how we're protecting the value of our stocks, right? How we're keeping that so that if it falls, we can add more to it. Again, back to the Warren Buffett thing. He's a little more on the end of having lots of cash and buying when there's a discount. You're more concerned about value when you're happy to see the price fall, because that just means it's a discount. Thinking about all of the stuff that has increased in price and products and the grocery store, right? Eggs up like 70%. Terrible time to buy eggs, right? But you think about if there's a discount, everything is cheaper. That encourages everybody to spend more, buy more when there's better prices, right? So why obviously should it be any different for stocks? Or in other words, why should it be any different for when we buy companies? I'll say when there's a sale, you buy more. Because we know the value of our companies, and if the price doesn't reflect that value for whatever silly reason, silly emotional reason, the stocks have fallen off, sold off. If we know our value, we know when there's a sale. Keep wanting to say stocks, and we really need to focus on companies. When you understand the value, you can figure out when there's a sale. If you don't understand the value, how on earth do you know if the company is cheaply priced or overpriced? Jesus, Tesla on sale right now? Was it on sale back here? Tesla still hasn't generated a profit. I mean, I can't remember. Maybe they did for one quarter, their first profitable quarter or something, but still in debt. It's not like they're fundamentally undervalued or anything like that. Have come down quite a bit, but doesn't necessarily mean that there's a sale. We can understand the value. So, all right. So the next point I wanted to make, think about the value of companies and alternative investments like gold. So saying stocks because we're talking about stocks in general, stocks versus gold. Companies generate income, profit. At least they're supposed to, right? Good companies generate income, profit, and growth. What does gold generate? How do you profit from gold? What do you guys think? You go and buy a gold bar for what are they? I don't know how much their cost right now. 1,500, 1,000, I don't remember. Haven't paid much attention. And then what do you do? How does that become valuable? What, how do you increase your wealth with that? Any thoughts? Obviously, you could trade with it, maybe. Can't go to the grocery store and buy anything. Jim says it provides a tangible asset in times of currency instability. It can, but it really hasn't been an amazing hedge to inflation. That's what's kind of always talked about, but if you look at some charts together with inflation and gold, it really hasn't been amazing at that. You really need to generate a return on investment. So how do you profit? How do you get profit from gold? You sell it at a higher, hopefully, a higher price than you bought it. And that's it. and we're not necessarily talking about, in the apocalypse and whatever, uh, you know, if we ever have to go back to a barter system, I don't know how much value gold is going to hold. The conquistadors in Spain were so fervent in getting gold and plundering the New World for its gold. They ended up having to buy food and crops and other goods from places like England, and pretty soon they run out of gold. All right, so the main point, you could look at stocks in a similar way as a commodity where you're certainly only concerned about the price and trading, or being a trader hoping that you can buy low and sell high. But if the huge difference there is again, companies, stocks are companies that generate stuff. They generate income, they sell things, they grow, they open new markets, they get bigger, they sell to more people, they have more profit, they grow. Gold doesn't generate or produce anything. It just is gold. And so again, Jim, going back to your comment, if you can look at the long term, short term, obviously the prices move on emotion and analytics of supply and demand of a certain stock, and stock overall volume, uh, trades on personal reasons. Someone's got to cash out, someone's scared of it falling down, et cetera, et cetera, et cetera. But in the long term, now obviously that's the short term. In the long term, stocks will trade on their value. Talking years, and sometimes it takes some time for the stock market to see that and for the stock to come up to that point. For Ford, it took freaking like 5 years. Jeez, stupid Ford. And now they're back down. How long is the next one going to take? I don't know. Hopefully not as long. I wouldn't think so. There's been 3 years where Apple just went sideways. There's just those times, and anytime there's a discount is a hallelujah chorus for us, because that means we know at some point it's going to go up. It's going to go back to where it's truly valued, and we're going to be much richer. All right, so you think about that. You think about a company, a stock versus gold. Talk about Apple versus Peloton. So why did I choose Apple versus Peloton? I wish I knew how to indent these properly. Peloton went into the stratosphere in 2020 when everybody realized, oh man, they're just selling stationary bikes like hotcakes, and they've got really nice product, and everybody's buying it. Has interaction. You can do virtual training with everybody, and since we're all stuck here at home, that's kind of the thing to do. And Peloton took off. Apple did the same thing, really. Everybody's buying computers. They got to do school at home. We got to work from home. But what are some differences here in terms of value? Because we know short-term view, the price, Peloton went ridiculous, and the fear of missing out kicks in, FOMO, everybody gets on the bandwagon. What happens? A bubble happens. So before I go on with Apple versus Peloton, a bubble is when how do I want to say this? Is when and I'll get this from a Warren Buffett book, or at least a book about Warren Buffett investing called Warren Buffett Accounting. You can look it up. But they made this point. No sustainable relationship between the value and the price of a company. So what happened with Peloton? Price got way ahead of its value. They could not keep up with the pace of growth in the company. Let me rephrase that. The company could not keep pace in growth with the pace of the stock price. In other words, the value couldn't grow fast enough, as fast as the price of the stock was going up. Certainly their value increased, a lot more people buying that. It just wasn't sustainable because obviously we're not going to be locked in here in our homes forever. They hadn't shown over many years and even decades that they've been able to deal with different business cycles, deal with interest rate hikes eventually, continue to innovate with more products. I know they have done a couple things, but they have a treadmill, for example, but there's no way they could have innovated or done anything quick enough to keep up with how fast the stock price rose. Compare that with Apple, undervalued. They have had decades of delivering value to shareholders. So it's a nice sturdy chair that you can sit on and know that you're not going to just break through it and fall on the floor. Peloton basically, I can't remember when they IPO'd. I don't think it might have been 2019 or early 2020. I want to say it was 2019. Maybe you guys remember. So they're basically showing for the first time that they could sell some products. So what's the difference? Let's talk about Apple. Apple has shown, how have they delivered value to shareholders? What has Apple done over the course of their time in as a public company to deliver value to shareholders, to deliver wealth, growth, profit to shareholders? Williams said came out with the iPhone. So that's obviously one of their biggest ones, right? Innovate with new products. They obviously had their computers. Steve Jobs came back to Apple and created the and got iTunes and the iPod, which kind of was the precursor there, in a big way. So in doing that, they created new markets. I mean, there were some, you know, MP3 players and stuff, but they created iTunes and the whole world around it, an iPod that was reliable and attractive, simple. They innovated. They completely changed the music industry as a computer company. And in so doing, they kind of also created a new market with the iPhone, especially. I mean, it wasn't necessarily a new market, but completely changed the market for phones. Nobody really wanted a flip phone. Nobody wanted anything with buttons. It was all about the iPhone, and Samsung and all the other companies and Google had to figure out how to do something that to get in that market to compete with phones, make smartphones. So I guess you could say they created the smartphone market. See, Jim said product improvement, innovation, leader, and taping a worldwide market. Yeah, so let's see. I'll say revolutionize. Tapping a worldwide market. Thanks, Jim. So product improvement, innovation. I'll say growth into new markets in the sense of geographic markets in other countries. Globalization, yeah, into new physical geographic markets, right? What else can you guys think of? We're at an hour here, so we'll wrap it up, but just wanted just felt like this was important to go over some of this stuff. But Kevin and I were talking about this earlier, talking about Apple, and he mentioned, pretty soon everybody's going to be sitting on their butts with, you know, computers doing everything at our beck and call and robots and stuff. And I thought, Apple must have already kind of foresaw some of that happening and gearing their products towards, active lifestyles. You got the AirPods that a lot of people run with, and that's just kind of the way they market it. You have the Apple Watch that they partnered with Nike on, and has uh, the health analytics associated with it, and going into the medical department and industry, all that kind of stuff. So, man, it's pretty tough to be compared to Apple. Sorry, Peloton, but geez. Oh, what was the other thing? They have the um, fitness market thing when they basically used iTunes, same idea with Apple Music and iTunes, and created a platform for fitness gurus and fitness instructors um, to do some of their fitness stuff online. Anyways, lots of ways that Apple has innovated, created growth in the process, opened into new geographical markets, opened new and revolutionized new products. Um, they didn't invent the phone, they just revolutionized it. And all of the new possibilities that come with that, with the App Store and then all of this other stuff. They've done an amazing job at generating value, income, profit to shareholders. Definitely not the same as gold. Definitely different than Peloton. You could compare it to Tesla, which has had some innovation, obviously. So maybe that would have been a better comparison, but Peloton or Tesla, that's moved a lot on news and emotion and price, and really doesn't have the value there that something like Apple has shown and proven over a couple decades now. And yeah, I think you guys get the point. Oh, here was one. Share buybacks. If you guys can think of any other ways that Apple has grown, here's your last chance. But that is pretty much most of it. And they provided, tens of thousands of jobs with any new facility they create, and uh, all the stuff they've done. It's been beneficial for the U.S., especially, and created jobs around the world. All right. That'll do it, guys. Thanks for letting me go on about this for an hour. That was a fun one. Let's focus on value. We pay attention to price, protect our value by protecting at higher prices, cashing that protection in at lower prices, buying more shares, generating shares over a long period of time, and having some serious exponential growth when value starts to be recognized in the form of price. So I'll get this one posted. I think this is a good one to be able to refer back to. Remember, let's look at these stocks as companies. All right, guys. Any last questions, thoughts before I hang up here? Thanks, Jim. Thanks, William. And yeah, we will see you next Monday. Kevin will be back. Looking forward to seeing what he has to say about some of the things we're going to do. Hopefully he can piggyback off of some of these thoughts because I thought they were important. And I'll admit I kind of piggybacked off of some of his thoughts from his Tuesday recorded webinar. And next Thursday I will be gone, taking the kiddos to Disneyland again, trying to help my Disneyland stock generate some wealth and hopefully go up and kind of create this wonderful circle of growth. Yeah, I won't be here next Thursday. Looking forward to seeing you guys Monday with Kevin, and we will talk to you next time. Take care.